You everybody for joining us today for this Diversify fireside chat today, talking about private credit. We're pleased to be joined today during our discussion by Michael Cohan, who's Managing Director at Cliffwater. Michael, welcome. Would love to just take a minute or two and give a quick intro of you and your background.
Thank you, Dave. As Dave mentioned, my name is Michael Cohan. I'm a managing director and senior member of our investment team over here at Cliffwater. Just to give a quick, firm background, Cliffwater was founded over 20 years ago as an investment consultant. We started out advising large institutional investors, such as public and private pension plans, on their alternative asset allocation. So, here at Cliffwater, we have, over 20 years of research experience, and that's across private credit, private equity, hedge funds, real estate, and real assets. In 2019, we started an investment management business, which today manages over 50 billion in assets across three interval funds. Those interval funds focus on private credit and private equity. And many of you may be aware, but we also founded and manage the private credit index. That's called the Cliffwater Direct Lending Index, or the CDLI. So thanks
Super.
again, Dave, for having me.
Yeah, thank you. And during today's discussion is obviously really timely if you've been following the markets and as it relates to private credit. The other important thing to notice is just the growth of private credit over time. Really, since 2008, we've seen a significant increase. So let's maybe set the stage, Michael, and let's first maybe define what private credit is and then talk a little bit about why it exists today.
Sure, I think that's a great place to start. So, we define private credit as a growing universe of asset managers that are outside the regulated banking system. So these asset managers are making loans directly to companies. These companies are typically owned by private equity sponsors. In return, for making the loan, the asset manager is receiving interest payments from the loan. And so the typical private credit loan, if you just take a step back and look at the structure, right? It's a first lien senior secured term loan it's a floating rate. So what do I mean by first lien? It means the loan sits at the very top of the capital structure, and the lenders have a first claim on all the assets and the value of the company if something goes wrong with the business. Just to make up like a representative example of a transaction in the private credit market, just to put some numbers behind it. So when a private equity firm buys a business, they don't finance that purchase price with 100% equity. So let's just say that a private equity sponsor is going to buy a business for $1 billion. The private equity firm will put in 50% of the purchase price, or 500 million of equity, and then they'll finance the rest of the purchase price. So in this example, 500 million, they'll finance the other 500 million with debt. The debt a private equity firm takes on to finance the purchase price is provided by a private credit asset manager. I think you also asked, why does private equity exist, and to talk a little bit about sort of the growth in the market. Well, really, private credit's been around for 20 years, but the growth trajectory has really increased significantly, post global financial crisis. So call it, 2008, 2009. Prior to that time period, so prior to the global financial crisis, banks could really underwrite and hold loans directly on their balance sheet. Post global financial crisis, regulators really didn't want banks to use depositors' money to invest in leverage loans. So the private credit market stepped up to provide financing to middle market companies. So that's really when you saw it grow. But the explosion or the growth in private credit really had to happen. Billions of dollars left the banks. If you think about like the predominant users of private credit capital, that's what we call middle market companies. So middle market companies in the US, they're responsible for around one third of GDP. These companies are constant consumers of capital. whether it be, a need to finance growth, fund CapEx, or, fund M&A. These middle market companies, just really need capital, and they need capital to operate their respective businesses. So as the banks have really gotten out of these markets, private credit lenders stepped up really to fill the void.
Yeah, and that growth has been significant over the last number of years. I think one of the statistics I've seen is going from about 1% of US nominal GDP in 2008 to being right around 6% today, with maybe an expectation that that's going to double in the next 5 years. So it certainly continues to be a growing segment of the market. It's something that I think also over the last number of years has evolved with in terms of access to just not your institutions, but your retail investors. And we'll talk about that a little bit more today. And so you kind of touched on, Michael, the reason for the growth of the private credit space, kind of post 2008, 2009. Um, are we seeing today any return of activity from those traditional lenders, or is it a segment that's going to always need to be serviced through more of private credit means rather than traditional?
I don't think we go back to where banks, dominate the market, because banks have really fundamentally shifted their business model over the past 2 decades. When I say banks, I mean like, Wall Street banks that are issuing, broadly syndicated loans. And today, the broadly syndicated loan market is really an underwriter and seller of risk into the market. So we like to say that in our industry, banks are moving companies, they're not storage companies. Banks are not using their balance sheet to hold risk in any meaningful way. The way banks are getting involved in the private credit universe, and many of your advisors and clients have probably read about this in the Wall Street Journal or other publications recently, is through providing leverage to private credit managers, funds or vehicles. That's really how they're getting exposure to this asset class, because those those um, um, those loans that they're making directly to the funds or the vehicles are collateralized by the underlying loans, but they can get those revolvers or ABLs or whatever the type of lending that they're providing to the vehicles. They can get those rated, so it's a better return of capital for the banks. And like honestly, like it's been almost kind of dating myself. It's been 20 years since the global financial crisis. Bank credit committees aren't just going to come out and just say, hey, let's go back into the market and let's start underwriting highly levered deals. If the Fed relaxes regulations, the banks have really changed their mindset post global financial crisis. And quite frankly, the market share that the direct lending managers and the private credit managers have taken is really here to stay in our view.
Yeah, it's interesting you say that. I recently saw a statement from Jenny Johnson, who's Franklin Templeton's CEO, stating that private credit is here to stay. So, um, definitely an area of the market that will continue to grow. That being said, there's been a lot of headlines and a lot of discussion in the news lately surrounding private credit. Really started in earnest towards late summer last year when you had some high profile bankruptcies occur in the market. And even more recently, kind of discussions about redemptions and so forth. Can you maybe talk a little bit about what's really causing those headlines and then maybe sift through perception versus reality?
Yeah, there's obviously been a lot of headlines, but um, I'll tell you that, there the headlines and the publications, the news publications, I should call them, they've been writing negative things about, private credit for a long time, really for years. Like you alluded to, Dave, last year the media tried to connect, some high profile defaults like Tricolor or First Brands. Those are public out there in the market. They've been public out there in the market. They tried to connect those defaults to private credit, when in fact these were not private credit deals, and both of those had elements of fraud. This year the news media really ran with stories around certain private credit managers trying to merge vehicles or sell assets, or do something at one of their platforms, that got caught in the media, and the media really tried to paint a narrative that there were cracks in the underlying private credit borrowers, when in fact the underlying portfolio health across the market has been really really strong. There's really a disconnect out there in the market with the fundamentals of the underlying portfolio companies and the negative sentiment in the market, which is driving technical pressure on private credit vehicles and managers. So obviously those headlines have led to increased outflows in retail products as retail investors took a risk off posture. I would also say a lot of these headlines, which again are trying to create a narrative that there's underlying technical or underlying fundamental pressure, which just isn't true. They came at a time when there was a lot of market volatility just in the broader financial markets in 2026, right? Stocks have had a difficult year, bonds have had a tough year. Really, all risk assets have had a difficult year. So that hasn't helped. I know we're going to get into it a little bit later, where I can have the opportunity to talk about some of the data. But Cliffwater manages the Cliffwater Direct Lending Index, which is an index of 20,000 middle market lenders. And excuse me, little lenders, middle market loans, those loans are not showing any significant defaults or any significant cracks, which I know we're going to talk on a little bit later, but we feel really good about just sort of the overall health of our underlying loans. And we're recording this in the middle of April, and recent bank earnings have come out that have also said that the U.S. economy, which the private credit market is really U.S. centric market, is very healthy. So that's our public data, which we released last week, shows health across the market, and public banks, bank stocks have released earnings that said the same thing. So it seems like the underlying assets are performing quite well relative or absent whatever you hear in the headlines.
Yeah, it's definitely kind of a tale of two cities, right? Perception versus reality when it comes to the fundamentals. That being said, I think one of the main focal points for those that maybe have a negative outlook on private credit would be related to AI or artificial intelligence and the impact that that's having specifically on software and some of the technology. And I think that's dominated a lot of the maybe concern in the market. Can you maybe talk about how that truly has impacted and maybe what the long-term view is when it comes to AI interruption?
Yeah, and it's interesting that you asked this question because, AI, we've been thinking about it at our credit committee for the past couple of years. The AI risk in the software space has been out there in the broader private credit market for the past year or two. It really got traction, I think, at the beginning of this year, when some public, hyperscalers or, public tech companies announced really high amounts of CapEx spending. I think that's really not part of today's conversation, because those are public equities, and we're talking about private credit. But I think our view at Cliffwater is net that AI is going to be a positive tailwind for software companies in the private credit market, because within the private credit market, the focus historically has been lending to vertically integrated software businesses, which are mission critical to a company's systems and processes. And when I say mission critical, I mean there is a high risk of failure if the software is ripped out, right? If you have Salesforce, for example, as your CRM tool, like, you can't just rip that out and have AI do that. AI can supplement and help run your CRM tool or your ERP systems more efficiently. We think it's going to be tailwind. So, software has been a big focus in the private credit space because of the amount of money private equity has invested in the space. Private equity, loves the software businesses because of really the high growth and the high free cash flow, financial profile. And just in terms of the broader market, software private credit loans typically have a loan to value of around 40%. So what I mean loan to value, that means 60% of the capital invested in the business comes from the private equity sponsor. So 40% comes from the direct lenders. So the lender, has to be really wrong if the enterprise value of the business erodes enough to really impair the debt. Um, and so I think, of course, will there be, some portfolio, or excuse me, some, underlying companies who could be negatively impacted by AI? Sure. But overall, we think it'll be a positive for software business in the private credit space.
Yeah, and that's really a nice segue into talking about kind of structuring and credit fundamentals when it comes to these portfolios or investments. And maybe can you talk through some of the structural considerations as a direct lender considers providing capital to a borrower?
Sure. And so yeah, maybe let me hit on a couple of different things. So right, so when we make a loan, I mentioned before, you know, um, the private credit manager is senior in the capital structure. So senior means the borrower's equity value is subordinated to the lender's position, and the lender has a claim on all the assets and the cash flow of the business. When loans are priced in the market, loans are priced as floating rate, meaning that the interest payment owed by the underlying portfolio company to the lender changes as interest rates change. So loans are priced with a combination of a floating base rate. So that's typically SOFR plus a fixed spread. That spread compensates the lender for taking credit risk. Other structural considerations, really the big one is covenants. So the loan agreement that is set up between the borrower and the lender typically has provisions which require the borrower to maintain certain financial metrics. So just to give you an example, the most common, financial maintenance covenant we see in the market is what's called a total leverage covenant. This means that the borrower must not exceed a specified amount of debt relative to its cash flows. So if its cash flows go down and the debt stays the same, that leverage ratio would go up and the borrower would be in default. So there may not be a payment default, but clearly something has changed with the original underwriting thesis. And that gives the lender, which is the private credit manager, the ability to get back to the negotiating table. And that lender has a right to call a default and work with the private equity sponsor, work with the borrower to come to some sort of agreement on how to fix the issue or the default. That could be more cash coming from the private equity sponsor or some sort of broader restructure. But the
Yeah,
main thing, just to end on that, is the main difference in the private credit market versus the broadly syndicated loan market is that the private credit market has a really tight document that is negotiated directly by the private credit manager. In the broadly syndicated loan market, the banks underwrite that deal, but then they sell it into the market, and the end buyer is actually not the one structuring the loan, which is a key differentiation for our market.
yeah, for sure. We've talked about the amount of capital that's coming into private credit and how that's grown. From an underwriting perspective, I guess how does a manager stay disciplined in that underwriting process when there's capital to be placed? And then on the flip side of that, what are some of the underwriting mistakes that you see most often in the market?
That's a good question. So maybe let me talk a little bit about manager selection because I think that that's kind of paramount in the private credit market. Because I just mentioned, before, like the managers are the ones sourcing, underwriting, and managing the risk. So the managers have a track record, right? No one talks about, hey, what's JP Morgan's track record in underwriting credit? But if you talk about a direct lending manager, you have to look at their track record. So the key is to avoid losses because at the end of the day, the private credit market is a universe of loans, right? You lend at par. You only get your par back plus earned interest or accrued interest. There's no upside like equity, so you have to focus on the downside. So managers that have the lowest loss rate, most stable teams, solid workout capabilities, and really long-term track records are the ones that are, going to are going to outperform over the long run across multiple credit cycles. So what does a disciplined credit manager, look like? The ones that we look at, stay away from, managers that have style drift. You don't want to invest with a manager that, wants to change what they're doing or go into a new asset class, right? You want to invest with the managers that stick to their core competencies. Those will outperform. Um, you want direct lending managers or private credit managers to underwrite a deal based on the merits and the financial profile of the underlying business. That's what disciplined private credit managers do. They don't try to stretch for yield in order to win a deal, right? As base rates go down, the interest rates that they earn go down. You don't want them to go do more risky securities or riskier loans just to try to maintain a certain yield profile. So the managers are going to follow um, those type of principles. I think you're going to see they'll have the best track records and outperform over the longer term.
It's such an important piece of it is manager selection, and something here at Diversify that we've been harping on a lot in all of our conversations when it comes to private credit, as well as all investment types, really. Let's talk about that rate environment a little bit. Over the last number of years, it's been a very attractive rate market. And one would even say historical highs when it comes to what those rates are. Where do you feel like we're at currently in the cycle from a rate perspective? And what's really what should be considered a normalized rate environment for private credit?
That's a good question. It's kind of a tough question to answer because the nature of the loans that the private credit market invests in are floating rate, and so when you look at how do changing interest rates affect a underlying borrower. So from a borrower perspective, as rates go up, the cost of borrowing goes up, and vice versa. From a lender's perspective, as rates go up, the amount of interest that they earn on loans goes up and vice versa. So post-COVID, as the Fed increased interest rates from effectively zero to over 5%, this caused the free cash flow to equity to go down as more borrowers' cash flow was used to pay the interest on their debt. That created higher income and returns for private credit lenders and private credit funds, and actually the end investors in those private credit funds. So that's really kind of been the phenomenon over, call it the past 5 to 7 years. Why I say it's difficult is because as base rates go up and down, the yield on these loans go up and down. So our view at Cliffwater is over the long run, the private credit asset class should produce a high single digit to low double digit return. If you look at the CDLI returns over the past 21 years, and just to remind everybody, the CDLI is the Cliffwater Direct Lending Index. So that's the index that we manage that looks at 20,000 loans um, within every single public and private BDC. So since 2005, so yeah, 21 years, that private credit index has generated an annualized return of 9.5% per year. So when you think about like what should I expect from this asset class over the long term, it oscillates around that 9.5% depending on where interest rates are. So it can be a little bit lower and it can be a little bit higher as you saw in the past couple of years.
Right. Um, let's talk about a little bit obviously the defaults and recovery considerations when it comes to private credit. Best case scenario with a private credit investment is return of capital and receive of interest. But in those cases where maybe one of the portfolio companies doesn't perform, give us a little bit of context as to what that really looks like is from a historical perspective.
Yeah, that's a great couple of questions. So maybe let me talk a little bit about sort of the historical realized losses that the private credit market has seen, historically. Maybe I'll talk a little bit about, relative value. It's not always about losses. It's about returns, relative to losses. And then maybe I'll talk a little bit about, when things go wrong, how do we look at that? So I just talked a little bit about the CDLI. Cliffwater Direct Lending Index. I talked about, since inception, 9.5% return. If you look at the realized losses in the private credit industry, so this is looking at the losses of those 20,000 credits, and again, that data goes back to 2005. The average annualized loss rate per year is around 100 basis points in the private credit space. So if you look at similar asset classes, and we think about private credit as a part of the leverage finance or the fixed income market. So when we compare returns or losses, we compare those to high yield bonds and broadly syndicated loans. So if you actually look at broadly syndicated loan losses per year, going back over that same time frame, it's 100 basis points. In direct lending or private credit, it's 101 basis points. So it's basically the same loss rate per year. If you look at high yield, it's 145 basis points of losses. But you look at the private credit returns, 9.5%. If you look at the broadly syndicated loans, it's 6.5% return per year. So you're picking up 300 basis points of incremental yield for effectively the same amount of losses over the same time frame. So 300 basis points may not seem like a lot of additional yield, but when you're talking about fixed income, that is not insignificant. So from a relative value or a risk-adjusted return, it's one of the highest performing leverage finance asset classes out there. And that data goes back 20 years, and that's not cherry picking any data. That's every single asset within all public and private BDCs, which is the publicly available information. So that's from a market perspective. Sorry, go ahead, Dave.
Yeah, I'm just going to ask, what drives that premium relative to broadly syndicated loans?
Yeah, so that's a great question, and that really goes back to why private credit or why borrowers would really invest or really choose a private credit loan instead of a bank loan, because it's not just the cost of debt. And then I think there's a couple reasons why that we would choose a private credit solution over a bank solution. And I think the most re the top two are really the certainty of closing, right? If you're a bank, you're only going to underwrite loans that you can sell into the market. And a private equity sponsor doesn't want to take risk at showing up to the deal closing and not have their debt fully placed. So they're willing to pay up in terms of a higher spread to go to a private credit manager because the lenders are going to fully commit to a deal. The lender fully commits to a deal because they have pockets of capital that they manage that they can put the debt into. The banks can only underwrite and sell what they think can be sold in the market. So if there's market volatility between, when they commit to a deal and when they have to close, they will rescind that commitment, and that's not great for a private equity sponsor. So you would pay up for that, and you pay up for the flexibility. Private equity sponsors want to know who owns their debt and wants the ability to come back to the lenders if they need more capital, let's say for an add-on acquisition. If they go back to a bank, the bank has to be open for business and the capital markets have to be there to syndicate the loan. That's not the case for the private credit manager. So the private credit manager will will charge more in terms of a spread, in terms of giving them committed unfunded capital to go out and do acquisitions. So it's the flexibility and the certainty and speed of execution that you get in the direct lending market, where lenders will, or where private equity sponsors will pay up for. I would say the last one is just the illiquidity premium that you get from holding these illiquid assets and not having a secondary market, because these loans in the private credit market are not traded. So they're non-CUSIP assets, they're not syndicated. So you can't go on your Bloomberg and trade them. So you want to get paid for holding illiquid risk in the market. And that's why you see that there's a pretty significant spread between the private credit market and the broadly syndicated loan market.
Yeah, and that's an important distinction, right? As we talk about liquidity versus illiquidity in the market. And that's both at the loan side, but also the investment side. And we'll get in here next and talk about some of the investment considerations for private credit. But before doing so, just one, it may be a broad question, but as you think about misconceptions as it relates to private credit, What are some of those misconceptions that you frequently come across?
Oh, um, that's that's a really good question. So I would say the two biggest misconceptions in the market is that private credit is more risky than bank lending, and it's less transparent or unregulated. I think both are untrue. So why do we at Cliffwater think that private credit um, lending is less risky? One, I think I mentioned it before, but there's much more of an alignment of interest between the private credit manager and the private credit investor. So in the private credit market, when you originate a loan, that is being held in the private credit manager's funds, i.e., they own the risk. Banks are selling that risk into the market. So when banks underwrite a deal, they sell it to CLOs, mutual funds, and institutional investors. So those CLOs, mutual funds, and institutional investors are not structuring the transaction, they're not negotiating the loan agreement, and they're not directly engaging with the owner of the business or the private equity sponsor. So there's not the same alignment of interest, which I don't think is probably understood well enough in the market. In terms of transparency, this one's my favorite because when you look at a bank's balance sheet, they don't list every loan, right? They just list their total C&I loans, total real estate loans, and their total amount of loans. When you look at, that's not true in a private credit space. When you look at a BDC, right, that's how we've been able to, create the index is because every quarter the manager has to publish their financial statement, which includes a schedule of investments. So it includes the amount they've invested, the current price of the loan, the name of the loan, and not only the price in terms of the spread, but the mark and the industry. And these managers every quarter are putting out their schedule of investment for everyone to see. And that's not only BDCs, but that's tender offer funds and interval funds. Now, I would also say, you know, private credit managers are really heavily regulated. They're all SEC registered, meaning they have to provide regular organizational updates and they're subject to government examinations. Private credit has grown. I think, Dave, you mentioned this at the beginning of the call. It has grown a lot because of the retail space. But remember, who continues to invest in this asset class and who see this asset class? Those are institutional investors. That's whom the SEC has deemed qualified to make informed investment decisions. And then also, a lot of these, investment products are offered to qualified, investors that the SEC considers of institutional quality and considers informed and smart and smart enough to make that investment decision.
Yeah, and so maybe as we wrap up today's conversation, let's talk about those investment considerations. You shared some interesting data points as it relates to private credit yields relative to some of the other, we'll say, fixed income alternatives that exist in the space, and even your traditional fixed income as well. Maybe talk a little bit about the opportunities that you're seeing both short term as well as long term that play into in investment considerations.
Yeah, maybe from just like a manager's perspective, certainly, in the short term, right, year to date, there's been a lot of volatility in the public markets. The private markets are always open. They have long-term locked up committed capital. So when you have pockets of volatility, which we had in Q1 of this year, think about 2022 when, we also had a war, or not we, but, Russia invaded, Ukraine. You had a war in the global markets and you saw market volatility you know, last year when, we had the tariffs and the public markets, shut down, that creates, both in the short term and the long term, the ability for private credit managers in the public credit markets to take market share from those public market participants who are really, open for business and lending new money when the markets are positive and the screen looks green. From an investor standpoint, I'll sort of bucket the short term and the long term opportunity is really the same. The goal for the investors should be to generate when an investor is investing in the private credit space, the goal should be to generate, a healthy coupon payment in the form of, a dividend income because of the floating rate nature in the fixed income, asset class with low, really mark to market volatility compared to public markets, really public equity and fixed income securities. And I would say that's really across sort of a short term and long term horizon. I would say investors shouldn't think of this asset class as something that they can market time. You really don't get paid to go in and out of this asset class. It's really a stable part, or should be a stable part of an investor portfolio as a way to generate that long-term, healthy yield. Because at the end of the day, that's what it's about. It's about the coupon payment and, generating cash flow that can be used to, fund retirement and fund, whatever an investor's end needs are from a cash flow perspective.
And then maybe lastly, as you think about the market opportunity for private credit going forward, um, one thing that you mentioned earlier was a likely borrower tends to be private equity sponsors. And over the last couple of years, the private equity markets have been, we'll say, relatively stagnant in terms of liquidity and activity. And the sentiment is that that's changing. And what we're seeing is more transactions occurring at the private equity level, which then, given the growth that we've already seen in private credit, to me, leads me to believe that there's going to be even more demand for the private credit space. Do you agree or disagree with that sentiment?
I agree with that. I mean, there's always going to be times when M&A is lower than expectations and higher than expectations, but the private credit market has evolved so much that the amount of private companies going back to the public markets has increased. The number of private companies over the past 20 years has decreased as more companies are staying private for longer. So the need for that private capital will always, will always be there, regardless of, whether, there's a lot of M&A activity or minimal M&A activity. Borrowers are always looking to, as the market evolves, right? There doesn't have to be a sponsor trade for there to be a new loan demand. Deals can be refinanced, deals can be repriced. So there's always market activity within the private credit market because of the growth in the private credit market over the past, 20 years, as we talked about previously.
Yeah. Well, I think that's a great spot to end our conversation today, Michael. Really appreciate you taking the time to share your insight and knowledge on the private credit space. And for those of you joining us, we appreciate your time for listening. And should you have any questions, feel free to reach out to your financial advisor as it relates to private credit. Have a great rest of your day. Thank you.